Hey everyone. Most of us grow up with a very simple idea about money. We are told that money comes from hard work, that if we work longer hours, learn better skills, and stay disciplined, everything will eventually be fine. We are told that saving money leads to security, and that governments control money by printing it when they need more. These ideas feel natural. They are taught in school, repeated by parents, and reinforced by everyday life. You go to work, you get paid. You save some of what you earn. You hope things will improve over time. But for many people, they never do. People work harder than ever, yet still feel behind. Debt keeps growing. Stress never fully disappears, and the economy always seems to need constant growth just to remain stable. This tells us something important. The story we are taught about money only explains the surface. It does not explain how the system actually works underneath. To understand money, we need to reset a basic assumption. Money is not mainly created by working harder, and it is not mainly created by governments printing it. In modern economies, money is created in a very different way. Money is not what we think it is. Most people think of money as something physical, cash, coins, paper bills. But physical cash makes up only a small part of the money system today. Most money exists digitally, as numbers on a screen. Your bank balance, your credit card limit, your mortgage, your student loan. These numbers feel real because they affect real life. You can buy food with them, you can pay rent, you can travel, you can survive. But they are not physical objects. They are entries inside a system. This matters because the way money is created depends on what money actually is. In modern economies, money is mostly credit. Where money really comes from. Most people believe that banks lend out money that already exists. That is not how it works. When a bank gives someone a loan, it does not take money from someone else's savings and hand it over. The bank creates new money. Here is a simple example. You go to a bank and take a loan for $100,000 to buy a house. The bank does not go into a vault and remove $100,000 in cash. Instead, the bank adds $100,000 to your account using a computer. That money did not exist before the loan. Now it does. At the same time, the bank records a debt. You now owe $100,000 plus interest. From here, the process continues quietly in the background. As you start spending that $100,000, paying the home seller, contractors, or moving the money between accounts, the funds move through the banking system. The seller deposits the money into their own bank, and that bank now holds a new deposit it didn't have before either. A portion of that deposit can then be used to issue another loan, creating even more new money on top of the first loan. This is how a single loan can ripple outward, multiplying the total amount of money in circulation without any physical cash ever being printed. The system is built on confidence. Confidence that borrowers will repay, that banks will remain solvent, and that deposits will retain their value. Here's another example. Imagine a small business owner takes a $50,000 loan to expand their shop. Once approved, the bank simply credits the business account with $50,000, again, newly created money. The owner uses it to buy equipment, pay employees, and order inventory. Those employees deposit their paychecks, suppliers receive transfers, and each transaction spreads the new money further through the economy. But just like before, every dollar created comes with an equal amount of debt attached. If the loan is repaid, that money effectively disappears from the system. If it's not, the consequences travel just as fast as the money once did, affecting banks, borrowers, and eventually the entire financial system. One action creates two things at once: new money, new debt. This is how most money enters the economy. Money is created through borrowing. This leads to a crucial idea. Money is created when someone borrows, not when someone works, not when someone saves. Work moves money around. Saving stores money.
Borrowing creates money. When a business takes a loan to expand, new money is created. When a government issues bonds, new money is created. When a student takes a loan, new money is created. The economy grows because debt grows. This does not mean debt is always bad, but it does mean debt is central to the system. Without new loans, the money supply stops growing. The role of interest. Here's the part most people never think about. When a loan is created, only the principal is created. The interest is not. If you borrow $100,000, only $100,000 enters the system. But you owe more than that. You owe interest on top of the principal. So where does that extra money come from? It can only come from two places. Either someone else must borrow more money, or someone else must lose money. This creates a system that must keep expanding. More debt is required in the future to pay debts created in the past. Why life feels like a treadmill. Many people feel like they are constantly running but never getting ahead. They work harder, they earn more, but expenses rise, debt grows, pressure never fully disappears. This is not a personal failure. It is built into the structure of the system. Because money is created as debt, the system needs continuous expansion.
When borrowing slows down, businesses struggle, jobs disappear, markets fall, stress increases. This is why recessions feel so painful. It is not because people suddenly stopped working. It is because the engine slowed down. Why growth is required. People often ask, why does the economy always need to grow? This is why growth is required to service existing debt. If the economy stops growing, there is not enough new money to pay old obligations. This leads to defaults. Defaults create fear. Fear freezes lending, and when lending freezes, money creation stops. That is why governments and central banks panic during downturns. They are trying to restart the engine. The system is not broken. Many people believe the system is broken, but it is not. It is doing exactly what it was designed to do. It rewards expansion. It rewards leverage. It rewards ownership of assets. It punishes stagnation. It punishes lack of access to credit. It punishes reliance on wages alone. This does not mean the system is fair. It means it is predictable. Who benefits the most? The people who benefit the most are those with access to credit, those who own assets, those who control cash flow. When the money supply grows, asset prices tend to rise. Real estate, stocks, businesses. People who own these assets benefit from expansion. People who sell time for money do not benefit in the same way. Their income is limited by hours and energy. Income versus wealth. Income is money you earn. Wealth is money that grows even when you are not working. Income usually comes from labor. Wealth usually comes from assets. In a debt-based system, assets benefit from expansion and inflation. Wages often fall behind. This is why income alone rarely leads to financial freedom. Why debt helps some and traps others. Debt is not the same for everyone. Debt used to buy productive assets can create leverage. Debt used just to survive creates pressure. A business loan that increases cash flow is different from a credit card used for groceries. The system rewards debt that produces more money. It punishes debt that does not. Understanding this difference is essential. Why this is rarely taught. Schools teach people how to work, budget, and save. These are useful skills, but they rarely teach how money is created, how banks really operate, or how debt shapes the economy. This is not necessarily a conspiracy. The system rewards participation, not understanding. Money is not just something you earn, it is something that is created through debt. Once you understand this, many things make sense. Why growth never stops, why pressure feels constant, why assets matter so much. The system may not change anytime soon, but understanding it changes how you move within it, and that understanding is powerful.